All right, looking good. Good afternoon, everybody, and welcome to today's Property Investors Council of Australia webinar, The State of Play for Australian Property Investors. Now, the timing of this conversation today is important. There's been a huge amount happening across the property investment landscape recently, from the federal budget and changes to negative gearing and CGT through to self-managed super fund borrowing rules. We've had rental reforms and a growing list of state-based changes affecting property investors. So we've got plenty to get through today, and we're going to start with the broader state of play for investors, then work through those major federal changes. We're going to talk about what's happening around rental regulation across the country and what all of this could mean for housing supply, investor confidence, and importantly, where PICA stands in terms of its advocacy efforts here. So please feel free to use the Q&A section of the webinar for all of your questions throughout. We're going to probably chat for about 45 minutes, and we're going to aim to have about 15 minutes worth of questions at the end. And to help us unpack all of this today, I'm joined by someone who's in the right in the cold face of these conversations, a highly respected property investment advisor, host of the #1 property investment podcast in Australia, The Property Couch, and of course, our chair at the Property Investors Council of Australia, Ben Kingsley. Ben, thank you so much for joining us today.
Thanks for having us. Looking forward to the conversation.
That's all right. We're going to dive straight into it because the agenda is huge.
Yes.
We're going to do what we can to get through it all. But as I mentioned, there's been just an enormous amount thrown at property investors this year, in the last few months alone. So before we get into the individual changes themselves, how would you describe the state of play for Australian property investors as it stands today?
Yeah, I mean, if we're talking about the moment that we're in right now, we're in what's referred to as a demand shock status.
Yeah.
So, the things that we look for when it comes to short-term cyclical movements, interest rates, availability of credit, income or employment shocks, tax reform, things like sentiment analysis and those types of things, and supply constraints. So we've got a couple of things working for us, which is the supply constraint and the cost to actually bring new stock on. But in the whole, we're working through a demand shock, and that's creating uncertainty. And when uncertainty happens, people tend to panic and not necessarily do the things that if they have the benefit of hindsight, they would potentially do. So yes, we know where this has started. It started with an inflation uptick off the back of the changes that were made at the end of last year, which saw property activity elevate, and we saw up to 40% of the market was investors. We felt that as much as we love them, they're our community. There's a balance in terms of who's driving the conversation versus and steering property prices and who's not. And so that's led to what I would consider the interest rate adjustments back to the 4.35. Now, at 4.35, property prices were still growing last year.
Yeah.
So that hasn't been. But then obviously the straw that broke the camel's back was the government's unplanned reform, unanticipated changes, and that spooked the market. And now we're in this demand shock, and we're seeing listings elevations elevate. We're seeing turnover drop, and we're seeing delistings also accelerate. So people are trying to see whether they can get something sold. If not, they're pulling it off the market.
And some of those markets that have been red hot for the last few years are the ones we're really seeing elevated stock levels in as well.
Yeah, that's right. I mean, look, it's only human nature to think in the short term that I've got this paper gain, and I'm sitting on this paper gain, and I'm thinking, well, and it could be a couple $100,000 pre-tax. So do I realize that bird in the hand, and then that might put us in a stronger financial position against our own mortgage.
Yeah.
And I'm fearful that paper gain, I don't know how long it's going to take before we get to that type of level again. So the short-term thinking and the actions off the back of that feels like the right thing to do. But I think history will judge us over the next couple of decades in terms of whether that was the right thing to do, or whether there was an opportunity to maybe release the equity and then see about how you're building that on. Because okay, good, you've whacked a couple $100,000 off your mortgage. That's material. There's nothing wrong with that. But it's like, my owner occupied home is not necessarily going to deliver me passive income or wealth in retirement. So I've got to judge that in terms of what it is. Now, if that means I pivoted with my plan and I want to go and upgrade the family home because now that's the tax haven, that if there's some other merit behind the decision, but if it's just to retire the debt, I'm not sure that that's the smartest decision with people's money if I think medium to longer term.
Yeah. Now, I mean, we've talked about sentiment already, but I mean, we know the fundamentals of the Australian market are still quite strong.
Mhm.
Um, this really is a bit of a shock to the system in terms of investor confidence, isn't it?
Yes.
So, what are you sort of seeing? Obviously, you've got your own investment advisory business as well.
Yeah.
Are you seeing that investors are just sitting in that spooked element, sort of simply trying to
Absolutely.
understand what the new rules
Absolutely, they
are
are.
and what's going to happen next?
Yeah, yeah. I mean, people are waiting for the next signal, right? Like
Yeah,
right now, there's no need to rush in their minds
yeah.
because we don't know. We are obviously in a downturn, so
Hmm.
and I would say even the last market that's probably holding up is Darwin, but our data is suggesting that that's probably turned now. Our data is weekly data, not necessarily monthly or quarterly or yearly because there's a lot of lag in that data.
Yeah.
So, so yes, we're getting a sense of, well, there's no sense of urgency. Um, and to your point, some of the other fundamentals are real. Like there's no explosion of supply coming on. If this was
No.
a supply-led shock in respect of where we've got an oversupply and
Yeah.
no demand, then this correction would last longer and be more severe. But
Mm.
because the fundamentals of population broadly are okay, we're seeing job losses coming, and there'll be more of those. But the reality is still, I'm looking for that next signal. And right now, I'm sitting on this idea of 50% flip of the coin chance of a rate rise,
Mm.
which could cause me further concern around affordability. So right now, yeah, we're just seeing the levels of inquiry and all of that really significantly fall off,
Mm.
and banks are reporting it. In fact, what the banks have reported into June is probably not where it's going to be. I suspect we'll see probably about a 30% decline in turnover, and
Mm.
I suspect that until people understand what the playing field looks like, and as it recalibrates, the market recalibrates itself, you'll probably see long-term 20-25% investor activity, and then predominantly 35% owner-occupier activity.
Yeah. Now, I saw Albo came out overnight with a handful of data. I'm not sure what data he's reading, but we've just had the ABS figures showing investor loan commitments fell sharply in the June quarter. So, you know, we're not really seeing it all go to flooding towards new build either.
No.
So he's sort of claiming this as a win. What do you sort of see there?
Well, of course, let's make no mistake here. Labor and Green governments are working against property prices going higher. They want property prices to be lower. They believe that that's a win state from an electoral point of view,
Hmm.
and they think that the vast majority of Australians want property prices to fall.
Yeah.
My view on that is be careful what you wish for. An 8% peak to trough change is $1 trillion
Yeah.
of value, so personal wealth wiped out. What's
Mm.
different to that though is the debts aren't being wiped out. So this this value that we have, that $1 trillion, $1,000 billion of money would be then flowing through the economy in some shape or form into the future, right? So whilst Albo and the government are trying to prosecute their narrative to the market, because remember, economics is the study of human behavior and business behavior, and the reality is that they're trying to sell the story, and the data that they're spruiking at the moment is around approvals.
Mm.
But just because you've got an approval, just remember those approvals they might have been in the quagmire of compliance and regulation 12, 18 months ago, and they're
Yeah.
now just starting to come out the other side. The reality is that with the cost of building, those approvals may not turn into completions.
Hmm.
And I think That's one thing politically we have on our side, is that the appetite from developers might be there, but the capacity and the feasibility for developers to get to work on building this stuff, it's not there.
No,
So
that's right.
so there will be a tightening of further supply that bodes well for rents, and it also bodes well for a debate around whether these policy settings are working, namely you know, the incentive that they're trying to change for investors to buy new, is probably still, they haven't won that argument with the investor just yet from
Yeah.
what we're seeing. And that bodes well too, because most investors who are worth their salt know that land scarcity, and location amenity and scarcity, does a lot of does a lot of that long-term compounding return when
Yeah.
it comes to property values.
Yeah. All right. So if I mean, the whole budget's been talked to death. Everyone's probably familiar with, the changes in relation to negative gearing and CGT. But I'm curious to know, with the grandfathering of these rules, what
Yep.
do you think you're going to see with investors who have already got those property? Are they going to be more likely to hold on to them? I just sort of see that as such a leg up. Like, why would I get rid of a property now? So we're not looking at investors selling up unless they're in, cash flow problems and things like that. We're just,
Yeah.
why would we let
Why
go?
would you? Yeah.
Yeah,
Well, again, the debate that's going on with the investor is a bird in the hand. If they've
yeah,
had a really strong result, do they take their profits? So that would be the only, in their minds, that would be the only sensible argument as to why they would tap out, right?
yeah,
The others, however, if they've got the right structuring with offset accounts, um, and they're playing the long game. In other words, they're not deviating from their retirement and their wealth building long-term strategy. To your point, Tim, that there is no reason why
mhm,
they would be, taking that position. So I get frustrated for the new investor that wants to come in and play, because
yeah.
they don't
Or
have that
the
luxury.
rent investor for that matter.
Correct. Yeah, reinvesting is very challenged. Actually, let's just quickly talk to rent vesting. So the traditional, 1.0 rent vestor, the concept was that they would continually keep renting and buy a portfolio of properties, and they would never buy. 2.0 became a thing where, young people, aspiring people were sold on an idea that in 5 to 7 years they can transact these properties, build up a really large nest egg really quickly, and then materialize, liquidate those properties, and then get into their family home in a suburb, an affluent or better location. So that's aspirational, but it comes with so many variables in terms of execution,
Mm,
that so many things need to line up, that the probability of that materializing was always going to be questionable. And that's unfortunately what we might see now over the course of this correction, which might last 6, 12 months, maybe longer, is that these people who have these paper profits and this desire to recalibrate that into a better family home, they might be seeing the values of those properties dropping, and the dream of realizing what they're doing. So they might also be, again, a reason to liquidate. So it's a fascinating one when I
yeah,
look at that. Bringing it back to the fundamentals, though, again, unless I'm in my 60s and I'm transitioning to a retirement target, or I'm getting advice from my financial planner about what to do there, most people should just be sitting on their hands and doing nothing. Or if they're in a very fortunate position to add to their portfolio, not a bad time to be getting your ducks lined up, and at least, um, you know, testing the market.
yeah. And do you think there's any possibility that we could end up with a bit of a unintended two-tier investment market here with grandfathered established properties on one side, and then you've got new builds carrying completely different tax advantages on the other?
Maybe. I think there's a general two-tier market risk in terms of concentration risk of where those properties are, Tim. So to
Yeah.
your point,
The greenfielding areas and
yeah, that's right. If I'm in greenfield, new development areas, there might be a greater portion of rental availability there for me.
Hmm.
So I'm very careful of that. But if I'm also in, new rezonings where medium and high density stock can also arrive, those developers do want, a healthy level of investors buying those assets, and so there is a risk there. That where this policy doesn't work well is in established middle ring areas and established markets where land scarcity is tight, and the only way you can really add new supply is turning one into two or one into three,
Yeah.
and that just takes time. And at the moment, even the return on investment on some of those developments, don't live. In fact,
Stack up.
I was talking to a developer, interviewed a developer earlier today, and he's saying the FISOs don't really stack up on one into two at the moment, and one into three is questionable especially you've got to take on a lot of debt. So why not just grab the old home there and just
Yeah.
renovate it and develop it into a really significant home, and all of the gains you're going to get in the future are capital gains tax free, as an example, right? So it's like it was Stuart Weems who
Yeah.
coined the phrase live vesting rather than rent vesting. So I think there is, an element of that households are going to be thinking about.
Yeah, I think you're right. All right, so let's explore housing supply and I suppose renters a little bit more. I think this is where like the bigger debate sits. Australia desperately needs more housing, but we
Yeah.
also heavily rely on private investors to provide that rental accommodation. So are we potentially discouraging rental supply at exactly the wrong time? Like we haven't had a balanced rental market of 3% in over 20 years. And yet this is where the government steps in and says, we're going to start curbing investor behavior. I mean, it just seems a bit illogical.
Yeah, I think it's disingenuous when you hear the treasurer, potentially the prime minister, and alike talking about when was the right time to introduce tax reform in property,
Mm,
and to alleviate, create the incentives that were needed. The reality is that what could actually occur from this is that we might see the total availability of supply tighten up significantly.
yeah.
And so, yes, whilst the incentives are directing investors to look and explore new, most investors who have been surveyed in the last 12 years through the PIPA investor sentiment survey clearly articulate that they're looking for a capital gain return over a yield return. And if that is the case, well, buying new substitutes that capital gain return, certainly in the first 10 years and all the data we've looked at, that there is an underperformance of new stock in that first 10 years.
Mhm.
So you pay a premium for it, and in some respects you might be paying a premium to give yourself your own negatively gear
Yeah.
tax money back. So you don't want to be caught in that trap. And two, yeah, usually those new properties are sold at a premium like a car running off a lot.
Mm,
So the resale value on those aren't going to be good. So then that, as we said, bleeds into the conversation around tenants and
mm.
what happens with tenants and tenancy availability. And yeah, again, I don't think that's going to be a positive thing. So, certain political parties have picked a fight with mum and dad investors, and they've told a narrative of the greedy in property investor. They've picked a fight with aspiration.
Mm.
So I'm hoping they don't win that fight.
That extends
Broadly.
further than property too, doesn't
Yeah,
it?
exactly. I
Mm.
mean, the dumbest thing they did was obviously the CGT changes to shares and other investments. That's just crazy, right? I mean,
Yeah.
ultimately, some young people are using ETFs and other vehicles, and no investment advice here, but to help them and assist them accumulate their deposit for their home.
Yeah.
But that's the challenge that we now find. So I suspect, do will they save face and reverse engineer and change? I'm not sure just yet,
Yeah.
unless they really lose that political gain. But then, they think their savior is the build to rent.
Yeah. I was going to
And
say, who's going to fill this gap,
yeah,
right? If investors do retreat, build to rent can't, materially change that overnight.
no, no,
They haven't got the scale
and the stock that build to rent delivers.
and the locations.
Yeah, is going to be so. Again, so this is where from my point of view as a long-term investor, and this is my bias, so I want to declare that to obviously everyone in our community. Your choice is your choice in terms of what you look to invest in. But our bias is towards established land and established property. And the point that, like when I see an article in The Age saying that, Melbourne's planning for 10 million people on
Yeah.
the same footprint without any urban sprawl than we've currently got, well, I think that's good planning, but that bodes really, really well for land scarcity and future productive use of land. And if we talk about from an investment philosophy point of view, margin of safety. So I feel a margin of safety in that, but I don't feel a margin of safety in the oversupply of medium or high density. There's no scarcity that I
Yeah.
hold in that. So for those people who are thinking that they are the choices, but yes, for them to again, you show me the incentive and I'll show you the behaviour. Those build to rents are getting concessions on land tax. They're getting concessions on bringing depreciation write-offs forward, and I'm even hearing conversations around them getting concessions around potential concessions around GST.
Yeah.
So,
And foreign investment as
well,
well, you know.
yeah, well, they need that foreign
They
investment.
need the foreign investment, but the problem is we're building properties that an Australian can never own.
No, well, yeah, yes, and if we look at the examples overseas in terms of the troubles that the tenants have in
Mm.
those, big conglomerate build to
Yeah.
rent operators, you
Mini
know,
ghettos.
yeah, well, yes,
We
they
haven't seen that here
become,
yet, but I can tell you in my time in the US, it's very
yeah,
significant. And
and
we're getting built to rent through at a very high spec at the moment because it's the
yep.
new fun toy for the government. But that will deteriorate very quickly over time when we start to
Well,
roll it out.
exactly right. I mean, when it's social housing and public housing, the government spends a fortune on it. They're very inefficient at running that. Well, when businesses are coming in, these businesses are wanting to be running at profits of 25 to 30% margins.
Yeah.
So the maintenance, the upkeep, all of the things that those tenants might be expecting to get in a generational cycle over time just gets worse. And
Yeah.
so it's not the silver bullet that the marketplace needs.
No.
Look, we need build to rent to be part of the mix. We do need to look after some of the less fortunate people in our community. We do need to have a safety net there somewhere. But the reality is also that you need a complete market. You don't just want to pick winners in that particular space. And so that's the challenge we've got. But they're picking a fight with aspiration, and they're picking a fight with aspiring property investors.
Yeah. I'm just mindful of time. So we'll move on from housing. One of the things we already touched on, CGT and negative gearing, but we've
Yep.
also seen changes to self-managed super funds, specifically around borrowing. And
Yep.
of course, there's been some media sound bites of Albo talking about superannuation being a national asset. So what's your take on what they're trying to do here in terms of control around people's superannuation?
Yeah, so I mean, I always like to tell a quick backstory in regards to when superannuation was introduced by the Keating government. Treasury told Keating that pretty simple that um, aging population, this big cohort of baby boomers coming through, there's not going to be enough money in the government purse to pay pensions to all of them,
Yeah.
right? So then it became a question of, all right, well, what can we develop and design that provides a safety net or a means by which those people can have enough money in retirement? So
Yeah.
that was the invention of superannuation. In other words, the government couldn't trust people with their own money because you give money, most people will spend it, live paycheck to paycheck. So this was a forced saving scheme at the time that had some attractive tax incentives to build up that nest egg. But make no mistake, it's the people's money. It's not the
Yeah.
government's money, but it's also the way in which they designed it. It did allow for the industry funds, which are part of the Labor family
Yeah.
and the union family, to get very big. And those industry and union funds are now quite powerful. And there's a political conversation going on with them to say, well, money inside these industry funds should be for the national good, as opposed to retail and personal investment funds. But that's a choice for the household in my mind. But if they want to be part of that story and help to build infrastructure out, Because the reality is we've got so much regulation in this country that we have real challenge of getting and attracting private investment into Australia, and we need more of that private investment to grow. If we don't get it, well, we've got trillions of dollars in super tied up, so they're expecting these super funds to do a national good. So the argument is this: it's like you've been able to build these super funds based off the Australian economy and Australian workers, so you need to pay it forward by providing further investments into the Australia. Now, that's not the mandate of a super fund, as the way I see it, is like you've got to get me an adequate return,
Yeah.
and look after my money well. So that's the backstory. And then, the invention of, or the emergence of self-managed super funds was one of, well, if I don't want my money in an industry fund or a retail fund and I want to take control of running my own portfolio of investments and become a trustee, then I'll set up my own structure and then I'll invest through that structure. And that's the backstory. We then saw non-recourse lending be established, and I was able to then borrow money to buy investment properties. That was obviously an effective way for some people to buy property, and it started to grow when we started to see more spruiking from buyers agents and alike, tax accountants encouraging that activity. So we didn't expect it to be pulled back so quickly, but the
Mm.
reality has been that, it has been pulled back, and so now we don't have that as a luxury. We can still buy residential property. We've got to buy it in cash out of the super, or we can still invest through our super fund into commercial property as well.
Yeah, I mean, I sort of see that in as a bit of a risky situation for a mum and dad investor as well. You're saying I can no longer do residential, which is, in most people's eyes safer, and certainly in the bank's eyes safer.
Yeah.
But you can go and do commercial, which you've got no experience in.
Yes.
The yields aren't what they were. All these different things that could,
Yeah.
put this person in a tougher situation. But the I want to sort of touch on something, and that is that, off the back of negative gearing, CGT, SMSF, it's basically like a broader philosophical sort of shift in how
Mm.
governments are viewing individual investment. And that's scary to me.
Yeah, yeah. I mean, I think if we're doing some very simple math for the politicians, if they're not renting and then they're owning.
Yeah.
And so if we make the price cheaper, crash the market down to get more of them to come in to buy, then technically we'll be okay. Um, that's a socialist democracy sort of view. More broadly, what that does is that the size of the economic pie shrinks, like the $1 trillion I was talking about before, right? So you shrink that economic pie and you just create less economic momentum.
Mm.
So be careful what you wish for in the medium to longer term. You become a basket case like the UK or certain markets where, that they struggle to deliver 1 to 2% growth in GDP per year. They're we're very fortunate in our resources and our minerals that continues to keep propping this economy up. Maybe some could argue it makes us a bit lazier because we do have that luxury of doing that. But yeah, if we want to have improved living standards and quality of life in the medium to longer term, we're going to have to continue to keep innovating, keep being more productive, keep doing all the things that are necessary. And these types of settings are very much around equalisation and wealth distribution, to accommodate those who think it's the government's job to look after them. And I think you'll see a divergence of our egalitarian society because, I mean, you saw the impact of the federal government's announcements. There was a visceral response
Yeah.
from a group of people. And what you do find in as younger people get older, they start with a Labor mindset and then, or well, probably Greens, then moving to centralists and then moving into a more liberal or business economic, run a stronger economy view when they get into their 30s and 40s. That's because they're working really hard for it. And if the government keeps taking more of that money away from them, that's what will happen. I mean, and if you kill off aspiration, then really that kills off innovation, it kills off productivity. And and you just have the government then going into all sorts of levels of debt. I mean, we just passed over $1 trillion of debt in this country, and higher debt just means higher taxes.
Yeah, that's right.
So, as much
We're
as
the
they're
highest
trying to
tax country in the world
redistribute
already.
wealth, yeah,
Yeah,
and that's their agenda. The big agenda
yeah,
here is we will redistribute wealth creation from capital to wages.
yeah,
Uh, that they're talking to their cohort of voters. That's their prerogative. But I think most Australians, you would think over the longer term, just want to make sure that they're comfortably looked after and they've got those resources. But you'll either move to a very high taxing society over time,
yep,
maybe like a Scandinavian type model, where higher wages, higher taxes. But then you'll also then look at, is that working for everyone is the broader question here.
yeah. Ben, we're coming up to the halfway point on today's webinar. So I just want to remind everybody that is joining us today. We had a couple of hundred people register for this, so I'm sure there are some pointy questions out there that people want to ask. Please feel free to put them into the Q&A chat as we go through, and we probably have another 15 minutes of content, and then we'll move across to your questions. So get your questions in there while you can. So Ben, stepping away from Canva for a moment, obviously we've seen significant tenancy reform occurring around the different states of Australia over the last couple of years. We've seen changes to different rules, pets, rent increases, minimum standards, landlord obligations, the minimum standards on housing, specifically down here in Victoria, which have come in recently. Do you think the balance between tenant protection and rental provider rights is shifted too far to one side and in some jurisdictions? And then more importantly, we have got people on this webinar today that are PICA members, but there's probably a lot that aren't as well because we went wide with the invite. So could you talk a little bit? You started PICA off the back of being a PIPA chair for many years. So, what does PICA stand for? What do we do? And I suppose in relation to a lot of these changes, where do we stand today?
Yeah, so PICA is a not-for-profit association that has the voice of the investor. PIPA, the Property Investment Professionals of Australia, has the voice of the trade and the industry.
Mhm.
And the view was when we started to see Labor and the Greens having broader conversations around changes to tax reform and changes to the marketplace, the debate would probably then center around self-interest trade, talking their own book type, and that and so the punter would potentially then say, well, it's a self-interest agenda. But then, there's 2.3 million property investors, individuals who have exposure to investment properties. Where was their voice?
Yeah.
And the trade in the industry, yep, we have a voice over here, and 90% of that alignment also is with what potentially the investor wants. But there is a clear delineation in some areas there that at the end of the day, as individuals, we get to choose to work with property investors, professionals. We get to choose to work with property managers. But what a
Mhm.
property manager ultimately wants isn't necessarily 100% in terms of what the investor wants or the owner of the property wants. So yes, we run private rental accommodation, and so we represent that voice. And so if you're not a member and you're listening to this recording or you're here live, we'd love to
Yeah.
have you on as a member because we're all volunteers. We don't get paid for doing this work, but the louder and the bigger we get, the better influence we have in terms of the market. Now,
Yeah.
coming back to where the tenancy reforms have gone, yes, it was time to make sure that tenants had safe and quiet enjoyment. I think, I think none of us want to be slumlords. None of us want to not ensure that our tenants have safe and quiet enjoyment of the asset as a customer of ours to use that property for that enjoyment. What we have seen is through government funding, a very powerful lobby has been established nationally, working on behalf of tenants and renters. And they have the ear of government through the left side of the Labor Party and obviously the Greens Party through that socialist left side of those political parties. And they have now started to implement significant reforms that are affecting our ability to run our private rent accommodation businesses. So at the end of the day, they're removing a lot more of our controls and a lot more of our choice. and the controls, the compliance add extra costs, and the choice adds the debate around whether it makes sense to basically be in this business or not.
Yeah.
So, a couple of the legislative changes, such as non-recourse, sorry, in terms of um, the ability not to remove a difficult tenant,
Yeah.
has
No,
made
no, no
that
grounds
no
evictions.
grounds,
Yeah.
has made that a little bit and the lengths that they've gone to try and ensure that there were no reasonable ways to be able to remove a tenant that's not necessarily living up to their side of the contract
Mhm.
and being the customer that we want them to be in enjoying our asset. So that's where I have high frustration. We're seeing it in also when we go to the tribunals to try and remove them or unpaid rent and all these other things. It's
Mm.
creating an administrative burden, an incredibly high frustration to be able to do that. And a lot of investors are sick of it. And so they're tapping
I
out.
think look, well, one of the hardest part is trying to keep up with all these changes, right?
Yes.
And especially as an investor that might have properties in different states, so you're not playing with one set of rules, and it's multiple sets of rules that are constantly changing. Down here in Victoria, the minimum standards, you can get a fine, and there's literally people turning up to open for inspections and handing out on the spot fines of $12,000 if you don't have your strings on your blinds. You go up to New South Wales at the moment, and I might decide to move a tenant on so I could sell my property. The market's tanked. I didn't get my price that I wanted after 3 months on the market. I now can't put my property back into the market to rent until the 12-month anniversary. I could be fined up to 75,000. So these are the types of rules that have come into play
Yeah.
that we're trying to advocate against and try to prohibit happening. But the funding that you're talking about with these, for lack of a better word, tenancy unions are advising tenants on the best way to reduce their rental increases and actually giving them call scripts and all sorts of things to try to help the tenant save money, which is all well and good. But we just don't have any. The pendulum's just swung too far into that side of the court, and we need to be able to advocate for investors' rights, but also educate stakeholders and policymakers about what happens when you go too far.
Yeah, Tim, and obviously for our entire community, these are critical messages that Tim is raising in the sense that if we don't organise ourselves into a reasonable communication to all of the stakeholders and the decision makers, because the perfect example is again in the great state of Victoria, which is collapsing under the current Labor government from an economic point of view, is I can't use the cost of running my business as a means by which I can pass on my costs.
No.
Now, I have to instead use a sample of what's happening in the local market and then the inflation rate in this state. Now, the reason why they use the inflation rate is because if you've got a collapsing economy or a poorly performing economy, usually inflation is low in those economies. When you've got a strong economy, that's where inflation can potentially creep in. But when you've got a poorly performing economy, like we do here in Victoria, your inflation levels are a little bit lower. So they're using that as the benchmark in terms of how to allow for adjusting of rents. And I just think that that's look against the spirit of an open market and a free market. So again, we're moving to a socialist type of approach to
Yeah.
what this sort of looks like, and be careful what you wish for in these types of areas because as people start to work out how to vote themselves the money, which is what we're seeing now, that's the collapse of your economy and it's a collapse of your society over time. As one great leader once said, once people work out or governments work out to spend other people's money, once all that money's gone, that collapses your economy. I butchered that a little bit, but
No, no, what you
the,
mean.
the
Yeah.
comment is something like the problem with socialism is when you run out of other people's money, and that's effectively what we're talking about.
Yeah. Well, no more so than Victoria, which obviously takes the cake for a lot of these big changes, and obviously quite regularly seen as the state that is
Yeah.
anti-investor.
Yep.
But I'm curious to know at the moment, like thinking about where we are right now, is there any particular reform that worries you the most, or is there any real issues that, whether it's land tax or regulation, compliance costs, interest rates, changing to tenancy laws, what is it that's the thing that stands out for you or keeps you awake at night?
Yeah, I think the biggest one in Victoria, if we're going to pick on, a poorly administered state, it is the land tax threshold
Yeah,
at 50,000.
50,000
Now, you compare that to New South Wales, which is 1 million,
million.
right? That is taking thousands of dollars of cash flow out of the business, and same
Not to
sort of
mention entry costs in Victoria for stamp duty and
thing.
things being much higher
Yeah,
too.
like you wouldn't set a business up in Victoria. Like their payroll tax, everything about the settings in Victoria are poor in terms of attracting startups, entrepreneurs, the whole thing, right? Under this current government. So that would be the main one. Obviously, the vacant land tax or vacant property tax is really, it's not a vacant land tax.
Yeah,
That is also something that catches people unawares in terms of you have to have your property um, uh, actively used for 180 days inside a year, or you get a 1% whack on the total value of property as a vacant land tax, but it's a vacant property tax, not
yeah,
because they've moved it from not just vacant land, it's actually got to do with property. And they moved it from Melbourne to Greater Victoria. And so many people don't know about that one.
yeah,
So that's a real problem. And probably the no grounds evictions where I would want to be able to make sure that if we, you know, marriages in this country start in a loving state, not just in a commercial state.
mhm.
Yet, there's a marriage that breaks down every 11 minutes in the state of Australia, in Australia, the nation, and so so they have irreconcilable differences. So I think there needs to be some mechanism by which if the tenant and not something that the landlord can just call. They can just,
Mm.
call it my asset, you get out, next one in. I don't think that's fair and reasonable. But what I think is if we can demonstrate that the tenant is not complying with the contract in place, that we should be able to remove them pretty quickly, right?
Yeah,
And I think that to me is a really strong one because right now what tenants are getting is all of these extra powers, which is really ultimately then just forcing the owner to sell.
mm.
And
Actually, Ben, you recently interviewed somebody on Property Couch who went through a
yeah,
situation like this. Do you want to just talk to about this
yeah,
podcast?
Dan's story was
Dan,
was one of it was a horrible story. He obviously they moved in, they didn't pay rent. They obviously treated the property with disdain, didn't care for the property, and it was
it was
very
on a current
confusing.
affair for anybody who wants to
Yeah,
see it.
that's
The state of the property, you would never, yeah,
and
you
we've
wouldn't believe
posted
it.
it on our YouTube, PICA YouTube channel, I think, in terms of those interviews. So it just highlights that there's bad actors
Mm,
in the rental side and there's bad actors in the property ownership side as well. They are the bottom 2%, 3%, let's call it. The
yeah,
rest of us want to just play fairly, but the regulation is really trying to, let's face it, they're trying to manipulate the market to their good. And in their mind, it's, these are well-meaning people, right?
yeah,
If I'm sitting on a phone in a call center of some type of rental support service, I'm just going to be hearing hard luck story after hard luck story after hard luck story, right? And I would want to potentially do something to help those people. But the reality is also that if that's their situation, it's not necessarily the responsibility of another private citizen to
no,
to make good all the time.
to provide free accommodation essentially is
Correct.
what he
Yeah,
had to do.
and to also then be, have their accommodation disrespected. I can't walk up to someone and take the keys of their car and just drive off in their car and not give it back. And then if the police pull me over, I've stolen that car and
Yeah,
I'll, be basically arrested.
yeah,
In the state of Victoria, people can move into a home and I can barely get them out. Yet in effect, it's a quasi steal of that asset, especially if they're not paying for it.
yeah. Look, I know we have no silver bullet to any of these problems, but I would be interested to know. We often talk about sticks and carrots. The West Australian government, was dangling sticks and it worked in their favour. A very proactive government to inspire people to go and invest in that state, even for short-term accommodation. Instead of hitting us with a stick and hitting us with another tax, they incentivised people to move from short-term rentals into long-term rentals. So I'm curious, in this environment, we've got this new set of rules that we've got to play by, but what would it take in terms of some changes that will make investor behaviour change now? What sort of carrots could the government actually provide to incentivize private investment to come back into the market? Because it obviously City is on the sidelines a bit at the moment.
Yeah, so we were calling for reform in capital gains area. We felt like property was being treated a bit too much like a commodity, a tradable asset, by certain sectors of the investor community, and that was unsustainable. So we knew we would lose our social license, and our social permission if that was the case. But
Yeah.
the government didn't consult with us. They've just dropped the capital gains tax reform on us, and the big one was the negative gearing one. So the value of a dollar today is worth more than the value of a dollar tomorrow. So that's the only difference in negative gearing. So um, that money was potentially more helpful for me to be able to buy and hold and retain the
Yeah.
asset. That is now deferred. So it just means that there's a smaller.
But the big flow on that is the borrowing capacity as well.
Correct,
Dropping
that's right. Yeah.
30%, it just kills a lot of investors' borrowing capacity instantly.
Yeah, and I think the banks and I think the regulator will be forced at some point to adjust their settings
Yeah.
to allow for a little bit more borrowing power in market. And if they do, that will be a good thing for spiking demand a little bit,
Mhm.
in terms of lifting the levels of demand that we've currently got. So, but it's still the incentives that we had in place delivered a level of rental accommodation, usually commensurate with the demand in the area over long term. Now, there is cyclical movements, when you get immigration spikes after COVID, where we saw an exodus of people, then we had a million people come back in the first 2 years. You know, that has that impact, right, in terms of that supply shock. And we were seeing household formations going to a lot of people wanting to live on their own or live in their very small setups. That's their choice as well.
Mhm.
So I come back to, I would like to see, from a federal level, just the negative gearing one be tweaked. The capital gains one, well, you know our view on that one. It should be back to the long-term standard after 5 or 10 years.
Yeah.
But in the short term, let's get rid of the speculators and the traders,
Yeah.
in terms of that space. And then, because if we are in the true business of providing rental accommodation, well, we want to do that for the medium to longer term. We don't want to speculate in the market. So
Yeah.
again, if we had a
Incentivize
consultative
people to
list,
keep property in the market for
yes.
longer in the tenancy and you know, not reward people that come in, do a renovation and flip it in 12 months' time and pay the same capital
Yeah,
gain.
because you could argue that could have been a first home buyer that could have
Yeah.
come in and renovated that property, and that would have got them in the location that they wanted to live in. But I think this stems back to this broader conversation, which is, yes, of course, all things being equal, I would love to live in a major city with all of the bells and whistles that come with that, from the international guests and the theatre and the artwork and all of the livability and the best restaurants and all of the entertainment. One wants to live in that city. It also gives me an opportunity for work, earning higher incomes, living a higher standard of living. But
Yeah.
the reality with that is that there is an economic impact to the value of that land,
Mhm.
and not everyone can enjoy that. But not everyone created that. It was the generations before that made that what it was.
Yeah.
And so the next generations get their chance to add to that, or to be successful and move into that and integrate into that setup as what they want, or go and try that regional town and build that up into an agglomeration center or whatever that may look like. That's the trade-off here, because I'd much prefer to be born in a country that allows me to have opportunity, and then it is the level of my effort is my opportunity, not so much what the government's meant to provide for me, right? I mean, I think it's that level of effort that I want to be responsible for to determine that, and the choices that I then make as a society. But if we, you know, what socialists try and do is they take what's working really well, and then well-meaning, whatever they are, they then come in and then they try and change that, and unfortunately, it cooks the economic wheel,
Yeah.
and then the governments go broke, which is what we're seeing everywhere around the world.
Yeah, but I think the only thing you missed in there, we might get some free dental.
Yeah.
All right. Now, we've done pretty well to get through the agenda. We've gone maybe 5 minutes over, but before we get to some questions, or anybody out there who has got questions, get them in now. But Ben, what sort of advocacy effort is PICA currently doing behind the scenes that our members and non-members should know about? And then lastly, before we go to questions, for people that may not be a member, what does it mean to be a member and how can people help us? You mentioned at the start, PICA is run by volunteers. We are a not-for-profit. We do run on the smell of an oily rag. And much to the help of you, pull your hand, put your hand in your pocket and pay for our CRM bills and all sorts of things constantly. So we really appreciate the work that you do. But for anybody else that wants to help, how can they do it?
Well, I think let's start with that first. So, by taking on a 1 year membership or a 5 year membership, that will help with cash flow.
Mhm.
Um, but then it's about whether you're going to be a passive a member or an active member. And to be an active member, we have state councils, and we have state advisory councils that, like what you run, Tim, here in Victoria,
Yep.
where people can play an active role. We can do meetups. Just think of the Country Women's Association. They're the sort of things we want to do. We want to get, and you can learn and you can share knowledge and you can get value out of connection of that membership through those meetups, whether they're virtual or actual physical signups and meetups. So they're the sort of things we want to deliver. In terms of the research and papers, well, when there's a government looking to asking for consultation, we'll do our best to resource ourselves to actually write a paper or attend an invite to a meeting or a facilitation of the change management going on in there. But again, that becomes very difficult because we have very small, revenues and turnover.
Yep.
So people who can potentially help with helping marketing, technology, legal, some of these sort of, writing some of these reports, supplying data, doing the preliminary research on that data, all of that sort of stuff helps,
Yep.
um, make our case in terms of giving us a voice to industry and to government as part of that story.
I suppose just the number itself of how many members we represent carries a lot of weight when we are talking to policymakers as well.
Yeah, I think that's an important point. So, yeah, we think that the two things we do as investors is we do provide rental accommodation, and that's a societal good, right? Because not everyone is a forced renter. People choose to rent for whatever reason that they do. It's in some cases it's forced, but in a lot of cases it's by choice.
Yeah.
But of course, off the back of that, why are we doing that? We're trying to also build up a wealth base for ourselves and our family to provide financial security, and not necessarily be a burden on the government come retirement. So we are self-funding our retirement by doing it. So we're taking calculated risks to invest for the long term, providing a community good during that stage, which will either be provided by us or, as you can see, big business. And I'm not sure big business has the same level of hearts that most property investors would have, and the same level of tolerance that mum and dad and aspiring property investors would have. So I think from that point of view, that's the message we need to get out to the community.
Yeah. We have got a few questions. A couple of them there are in relation to our memberships. So just for everybody who may not be a member, it's $25 for a single year, or you can get 5 years for 100. And obviously, all of that money just goes into paying our bills essentially and helping us stay alive
Yep. Yes.
and,
Stay
and
liquid.
solvent.
Stay solvent. Yep.
All right. I've got one here from Bev. Bev says, I see the changes favorable to those who own investment houses, as in the future, the 50% CGT plus yearly inflation. If I'm correct, then those who held an investment house and kept it for over 20 years will be better off holding until it's favorable to sell.
Yeah. So in other words, the 50% from 30 June next year, the 50% capital gains tax discount will be grandfathered as well.
Yeah.
And then you'll have your new cost base, and that new cost base will be indexed. And historically, the longer that you hold on to that property, that indexation will be better for you. In other words, you'll pay lower taxes. So, under the indexation model, it's clear that if you make quick gains, you're paying a higher level of ultimate tax. So, the marginal and the minimum tax rate that you will be paying is 30%. So, what you're trying to do over the longer period of time is get that down to that level.
Yeah.
Whereas under the current system, historically, depending on what your marginal tax rate is, that could have been around the 22, 23 cents per
Yeah.
dollar. So it means that the government is obviously getting more of your gain.
Yeah. Ben, we've got one from Lisa. It says, Ben, are governments adequately measuring the cumulative impact of all of these reforms on one individual investor?
No.
I thought it might be a short answer.
Um, the reality is with the ATO data, what we'd also love to see in that ATO data is a breakdown of the type of property
Yeah.
that they're that the 2.3 million does have a blend of commercial in there as well, because the reality is that you can negatively gear a commercial property going forward. So I don't know what they're going to do there, but I'm hoping that that new data will be available. Um, and in theory, if that is correct, if we can get the type of asset correctly identified, then the tax return should be enough data to Lisa's point, to be able to get some more intelligence around that. So what we do know in the data of the number of households that are claiming interest, the number of households that are positive cash flow versus negative cash flow, and who are paying tax, and obviously who aren't paying tax on that income. But
Mhm.
it would be nice to have that separated out for resi versus commercial.
Yeah.
Um, there'll be a small nuanced group of people who have mixed use properties that
Yeah.
will probably try and now claim them as commercial properties
Yeah.
because of the zoning. So there's going to be a little bit of grey area there, but I think over time we should be able to get access to that because it's pretty simple. Like some longer term investors are positively geared on their property because they've
Yeah.
had them for the long term. So usually over time, as you pay down the debt, you'll see the rent will cover all your expenditure, and you'll start receiving positive cash flow of which you pay tax on.
Yeah, that's right. A couple more questions. I got one from Dane. It says, will the 3.2 million investment properties in Australia all need to be valued on the 30th of June, 2027? There's been a lot of talk about this recently.
Yes, I've literally just finished a recording on that particular topic. So yes is the short answer, and you can't use AVMs.
Mm,
So from our understanding, um, if you've got an AVM provider who is not a registered licensee of a valuation under a valuation license, that will not qualify. Now, the important thing here is that they'll need to make some changes, but from 1 July 2027, we're supposedly meant to have all of these properties valued by that time. And if we don't, we can potentially have them retrospectively valued. Um, but there's going to be about 8 million valuations that need to be done on businesses and property assets, and that's just incredibly ludicrous. It's a one-off cost that we all have to bear the cost of. So it's
But then,
impossible.
am I right to say the old indexation of CGT, did that have to happen back then? I hadn't thought about that before now because they'd have to.
So you
Because
can,
the
well,
previous CGT rules are
yeah,
pretty much what we've gone
85,
back to. Yeah.
correct.
So did it have to happen back then? I don't recall.
Um, Between 85 and 87 when they
Yeah.
had the change. Yeah, I don't know the answer to that question straight off the
Hmm.
top of my head,
Yeah.
but obviously also remember that pre-85 capital gains, they also need to be valued as well now. So
Yeah.
they will incur a capital gains tax going forward. So the gains from 1985 to now. And of course, the thing that frustrates all of us is that this move has amplified the correction in property values. So
Mm.
our values are going to be a lot lower, of which the government then gets to recollect because we can't value them now. So they're going to get a windfall, a tax windfall off the back of the price correction that they created. That annoys me the most, but it demonstrates their willingness. They just don't care. They are happy to see property prices fall. They think it's a vote winner,
Yeah.
because what they will announce in the next upcoming election is tax cuts. Now, how big those tax cuts are going to be is the interesting thing. Like, is it going to be material? Are we going to give every Australian an extra, was it $2.75 a week?
Yeah.
Or are we going to give, them something more meaningful? And that's
Mhm.
that's that's what Jim Chalmers is basing his political future on, as an aspiring future Prime Minister, is what he's trying to do there. So I don't know the answer to that, in terms of what we did in the past, but I can tell you that yes, every one of those properties needs to be valued, and don't think that you can use an online AVM provider, unless, because this is policy on
It's
the run,
accredited. Yeah.
unless there's some other changes that they make. Because in
Mm.
speaking to Greg Sugars, who's the CEO of a valuation firm that I just interviewed for one of my shows, he is basically saying that it's impossible
Possible.
for
Yeah.
6,000 people to do 8 million valuations.
Yeah.
Impossible.
All right, we've probably got time for one more. I've got one more here that is saying, do you expect investors to increasingly favor commercial property shares or other asset classes?
Again, a very timely topic. Maybe, but
Mhm.
I'd be saying be very careful, in terms of your due diligence. Like, if the investor does lazy research and they think, oh well, just to get a tax gain, I'm gonna switch over to commercial. I just had a good hour-long conversation with two valuers exactly on this topic, and they've got certainly an appropriate level of warning signals
Yeah.
to say around commercial. The cap rates aren't stacking up, the yields aren't stacking up, the supply risk isn't stacking up, the demand isn't stacking up. So be careful what people are saying around commercial, because of the horror
Yeah.
stories where you won't have a tenant for a year plus, or if you do attract a tenant, you've got to bend over backwards with 6 months, 12 months.
Yeah,
You know,
incentivize them. Yeah.
it's a very interesting area. Personally, I'm very happy to share my personal views on this. Um, there probably now comes a time where the trade-off between the land that I'm acquiring and its location and the price that I'm paying for that, in other words, what I'm substituting in terms of where that land is located,
Yeah.
regional town, whatever it may look like, under a certain value. In my case, it's 600,000. Under that value, my preference is I will probably not invest in property, period. So
Yeah.
anything above that level, is it potentially brings me into a market location that I think makes sense for future capital growth, and not just replacement cost growth, because that's what you normally get in most remote regional areas. Is the replacement cost is, so there's the land value, which is really low, and then the replacement cost. So your land to asset ratio is all out of whack. Should be the other way around, because the land appreciates and improvements depreciate. So what I'd be looking at there is saying, okay, I don't have enough to play in property and commercial is a bit too risky. Maybe my alternative options is to explore other investments.
Yep. No, I think you're right. All right, Ben. Well, thank you very much for taking the time to join us today. And a big thank you to all of our guests that came along, both members and non-members. For anybody who wants to know more about PICA, you can head to pica.acn.com.au. Oh, no, ACN. Oh, that's right.
Yep,
acn.au.
yep, that's it.
Is that the right one? I can never
Uh,
remember with acn.au instead of the .com. I never get that right.
no, it's ASN, I think it is.
ASN,
Oh,
pica.asn.au. I put the link in the chat anyway. I just don't know how to
yeah,
read it.
yeah, ASN, yes. Yeah, not ACN, ASN. Yep, that's the one.
Good stuff. So,
Thanks,
yeah,
Tim.
to everybody who enjoyed us, thank you for your time and your questions. If you want any more information, head to the website. For those who aren't PICA members yet, I hope you found today, useful, and you got some really good understanding of what's happening with the latest changes. We obviously need to have a really big voice at PICA. We need to grow our memberships. We need money to do that. So if you're not a member, please do so. $25. We'd love to see you at our next webinar. Thanks, Ben.
Thanks, Tim.
Good on you.